In this video, I'm going to share with you an easy, proven, fully mechanical, rules-based trading system that takes all of the guesswork out of trading. This strategy has allowed me to get funded over $1 million, but I don't want you to take my word for it. Here's a sneak peek of some of the incredible results that my exclusive members have achieved trading this exact system. For those of you that are new here, my name's Liam and I've been trading, investing and coaching within the financial markets for the last 8 years. And I'm also a mathematics and finance graduate from Newcastle University. And so with that being said, let's dive into this video. One of the biggest problems that traders are facing is that trading based on discretion and emotion rather than trading based on a system and a rules-based approach. So by the end of this video, you're going to have the exact step-by-step framework that will take all of the guesswork out of your trading. What I've done is I've broken the system down into 4 simple steps. Step number 1 is a daily directional bias. Step number 2 is a session-based manipulation. Step number 3 is our confirmation. And step number 4 is our stop loss and invalidations. And also what I'm going to do at the end of this lecture is I'm going to share with you case studies of 6 trade examples. Okay, so step number 1 is daily directional bias. This is a huge problem that so many traders are facing. What they're often doing is they're using subjective ways in order to identify a daily directional bias. So this could be something like a 4-hour order block. This could be a daily fair value gap. There's unlimited ways in order to identify a daily directional bias. The problem is so many of them are very subjective. And whenever something is very subjective, you then feel like you're no longer in control of the market. And what I found happened was, I'd look back at the end of the day, 1 minute I was long, 1 minute I was short, and I was constantly flip-flopping between long and short bias. And I look back at the end of the day and I've took 15 positions, half of them long, half of them short. And I'm almost like, what the hell happened? So it's really important that when we're turning up to the markets, we have a very objective way and a very rules-based way to look at the market and go, okay, I'm long biased today, I'm short biased today, or, I have no bias or the market is just consolidating. Okay, so this is where you're going to have to hear me out. What I found is a very objective, rules-based way to identify daily directional bias is by simply using exponential moving averages. So for example, if the 50 EMA is less than the 100, which is less than the 200 EMA, this is going to indicate to us that we have a sell daily directional bias. For example, if the 50 EMA is greater than the 100 EMA, which is greater than the 200 EMA, this is going to indicate that you are buy bias in the market. If the exponential moving averages are crossed over, this is going to indicate no bias, and this is going to indicate a ranging market regime. So it's very important that if we have a sell bias market, i.e. 50 is less than the 100, which is less than the 200, we are only going to be looking for shorting opportunities. If we have a buy bias market, i.e. the 50 is greater than the 100, which is greater than the 200, it's very important to note that we are only going to be looking for buying opportunities. And if the EMAs are crossed over, well, we have no bias. This is indicating a ranging market regime. And so we're going to be sitting on our hands. We're going to be remaining very, very patient. Okay, so now let's have a look at some examples of our daily directional bias. So if we just zoom in right here, this is an example of a sell bias market regime. What can you see? Well, clearly, the 50 EMA, this is the green one, is less than the 100, this is the blue, which is less than the 200. So this indicates to us that we have a sell bias market. This indicates that our daily directional bias is sell bias. So therefore, we would only be looking for shorting opportunities. And then every sort of pullback in price may be an opportunity to look at shorting this market. So this is actually ES on the 15-minute time frame, and this is a 1 time frame strategy. So the majority of my analysis, my executions, everything is going to be based on the 15-minute time frame. And you can see this market remained sell bias for some time, right? We also remained sell bias right here. The EMAs were still sloping to the downside. They are still in order, indicating sell market conditions. What ended up happening? Well, we got this pretty huge sell-off right here. And so this is just a really easy filter, which is going to prevent you from sort of chopping and changing where like 1 minute you're long, 1 minute you're short. This is going to help keep you grounded. Okay, now let's look at an example of a buy bias market regime, right? You can see the 50 EMA is in green. This is greater than the 100 EMA in blue, which is greater than the 200 EMA in red. So this indicates that we have a long daily directional bias, and so we are only looking for long opportunities. So what this is basically telling you is that any sort of pullbacks in price are opportunities to look at buying the market. So we would be looking for price to come lower before we can look to trade this market higher. You can see we had a bullish market regime for some time. Again, this is ES, this is the US 500 on the 15-minute time frame, and you can see, right? 50, 100, 200 EMA, and this trend continued for some time. And this is the thing, right? When you're trading very bullish assets like the likes of ES, the likes of gold, assets that trend very heavily, it's important that we're trading with the trend. Because when they trend, they can trend for days, weeks, even months at a time. And so it's important that we are in line with the flow of the market. And that is why this is number one, because this is the most important thing. If you cannot align with the flow of the market, you're already essentially fighting an uphill battle. Let's have a look at a no bias market regime, right? If we take this period of price right here where the EMAs crossed over. So we were sell bias, right? We had the 50, 100, and 200. But what happened right here? Well, the 50 crossed over the 100. They're now not in order. And you can see since we crossed over, the market pretty much just went sideways after the crossing of the EMAs. And so this would be an example of where we just sit on our hands. We're going to be extremely patient. We're not looking at taking any positions. So this is where we have to be very disciplined to where, we're looking at the market and we understand that the market conditions are not very clean. We don't really know who is in clear control of the market at this stage. And so it's sort of like a warning sign to tell you that, okay, something's going on here. I don't really have a clear bias. I don't really have a clear understanding of where price is more likely to head to. And so if you don't know that, well, it's best to stay out of the market. And so that is the 3 different types of market regime that we can have. A very common question that I often get asked is, does it matter if the gradient of the EMAs is, sloping heavily versus, fairly flattening out? Not for this system. So it doesn't matter if the EMAs are sloping to the downside heavily, whether they're flattened. All that we care about is, are they in order? And so this helps to keep it fully mechanical, right? Because as soon as you start looking at maybe gradients of EMAs, well, how do you define this in an objective way? It starts to add quite a bit of nuance and kind of subjectivity to your trading system. And so that is probably the most frequently asked question that I get regarding the EMAs. But as long as they're in order, this is okay. We have a clear bias, and so we can then move to the next one. Okay, so step number 1 was amazing, but if you don't understand step number 2, it's very hard to time the market correctly. And step number 2 is a session-based manipulation. So let me draw out an example of sort of what I mean, right? Let's say that we have a bullish market regime. And so let's say that we are long bias on this market right here. And let's say that this right here is the Asia session low. So what we have is the Asia session from 7 p.m. until 12 a.m. midnight. We have the London session from 3 a.m. until 5 a.m. Eastern. And we have the New York session. This is from 8 a.m. until 10:30 a.m. Eastern. So what you're going to do is mark on the high and the low of the Asia session between 7 p.m. and 12 a.m. midnight. So let's say this is the Asia high right here. Let's say that this is the Asia low right here. And so what you're going to be looking for, let's say during a London or a New York kill zone, you're going to be looking for price to come lower, manipulate below the Asia session low. What this is going to do is it's going to stop out any early buyers, right? Think about anybody that was positioned long in here. Well, their stop losses are going to be resting below the Asia session low. And so this is going to stop them out. So whenever somebody that's long is getting stopped out, this is going to force them to sell at current market prices. Also, a lot of traders are going to see this as a breakout to the downside. So they're going to see price as soon as it comes below the Asia low or below the London low. They're going to see this as a breakout to the downside. And so this is going to induce them short into the market. So what this manipulation is doing is creating a huge inflow of sell orders into the market. Essentially, it's trapping a lot of traders on the wrong side of the market. And as we know, the majority of traders lose money in these markets. And so if we understand that at this point in the market, lots of traders are getting short into the market, this is what provides the fuel and liquidity for the bigger players to actually move the market in the intended direction. So essentially, this manipulation right here is creating a huge inflow of sell orders, which is providing the liquidity and fuel for the bigger players to actually get positioned into the market. So if you're trading a New York session, this low, this sort of range right here could be the London high and low, right? If you're trading a London session, this range right here could be the Asia high and low. So it doesn't have to be Asia. It could also be the London session high and low as well. So if you're trading the New York session, you can have both potential scenarios, where scenario 1 would be a manipulation of London, scenario 2 would be a manipulation of Asia. And so this is what we call session-based manipulation. So now let's have a look at some live trade examples. So again, we're looking at ES on the 15-minute time frame. What's our bias, right? Well, we are long bias. We have the 50, 100, and 200 EMA. So we're only looking for long positions in this market. And what have we seen? Well, we've seen a manipulation of the London session low right here. This is going to induce a lot of traders short into the market, thinking that this is a breakout to the downside. And this is also going to stop out any early buyers, right? If you're long in Asia or maybe pre-London, well, you've just been stopped out. And so that's going to force them to also sell at current market price. Now let's have a look at a sell example of a session-based manipulation. Right? So in this example, we're sell bias in the market. Why is that? Well, the 50 is less than the 100, which is less than the 200 EMA. What have we seen? Well, during a New York kill zone, we have the London high. We've seen a manipulation above the London high. And so we can start to think about taking a sell position. A lot of traders are going to see this as a breakout higher. A lot of traders who were positioned in London or positioned in Asia, well, their stop losses are going to be above these session highs. And so they're going to be getting stopped out, which is going to force them to buy at current market price, along with the traders that have been induced long into the market. And it's really in turn that the accumulation of these long orders is what provides the fuel for the bigger players to actually position themselves short into the market and looking at getting positioned into the flow of the market, which, as we know, is to the downside. And so this is an example of a sell bias market where we have witnessed a session-based manipulation. Okay, so step number 2 is fantastic, but if you don't understand confirmation, you will not know what you're looking for in order to enter the market. And I like to keep my systems very, very simple. So let's say that we are long bias in a market, and let's say that we have seen a form of manipulation lower. So all that we're simply waiting for is a 15-minute bullish confirmation to indicate that buyers are actually stepping into this market, right? Because when you're looking at a session-based manipulation, you don't know how low this thing's going to go. So unless you're waiting for the market to show its hand to indicate to you that momentum is actually stepping to the upside, you're literally going to be trying to catch a falling knife. And so what we're going to be waiting for is a break of this 15-minute bullish candle high. This is your trigger to get long. So something really, really important to note is that the confirmation has to occur during a kill zone. So we have the London kill zone. This is between 3:15 a.m. until 04:59 a.m. So this is the London kill zone. And your confirmations can occur during the New York kill zone. This is going to be between 8:15 a.m. up until 10:29 a.m. And so this is the New York kill zone. So it's really important. I'm going to repeat this again. Our confirmation has to occur during the London kill zone between 3:15 a.m. until 4:59 a.m. or the confirmation has to occur between 8:15 a.m. Eastern and 10:29 a.m. Eastern. We're not looking at taking trades outside of these kill zones. And the reason why is because outside of these kill zones, there's a lack of volume. So what I found is the market tends to trend very heavily during these kill zones. There's a lot of volume, there's a lot of volatility. This is when we get a lot of price movement. And so if you take a trade outside of these kill zones, I'm not saying that it's, not going to work out, but that trade certainly has a lower probability of success. It's really important as well to note that we're going to be entering on the break of the candle high. So we're not entering on the closure, right? We're entering on the break of this high. And again, this is to indicate that further momentum is actually stepping into the market, because if you enter on a closure, you don't know if price is just going to go lower and break this low and then stop you out. But if you wait for the break of the high, well, what this allows you to do is it allows you to enter the market as price is actually pushing to the upside. So momentum is actually coming into the market. And you're also going to be getting a second higher high on the 15-minute time frame, right? Because you're going to have this next candle right here, which has made a higher high. And so this is going to be the second higher high after manipulating. And so this is, again, a very bullish signature in price. It's also very important to note that we're going to be entering via a buy stop in the market. This is, again, to help keep everything mechanical. So when you see the confirmation, you're going to place a buy stop above the 15-minute candle high. You can look at the markets visually and enter via a market execution. The problem is that you may miss the trade or you may get into the trade late. And so if you enter via a buy stop, you're treating the market very mechanically because your entry is going to be uniform and it's going to be the same every single time. Whereas if you're trying to market execute, you may enter up here because you're late. Price maybe it already pushed up to here. And so it just helps to keep things very mechanical. Okay, cool. Let's look at a sell example confirmation, right? So we're sell bias in the market. We see a session-based manipulation higher. What are we waiting for? Well, we're simply waiting for a 15-minute bearish confirmation, indicating that sellers are actually stepping into the market. We can then enter on the break of this candle low via a sell stop in the market. And we can enter as price breaks the low as it pushes with momentum. And this is a valid confirmation. So remember, this is a one time frame strategy. This is all based on the 15-minute time frame. And so this is going to be a 15-minute confirmation. So this could have been your Asia or London session high right here. We've seen the manipulation. This could have been during, let's say, the New York kill zone. And then the confirmation has to occur during 8:15 a.m. Eastern and 10:29 a.m. Eastern. So if you're not tagged short or long into a position during these windows, you're then going to be sitting on your hands. You're going to have to come back in the following session, the following day, and rinse and repeat the system. Okay, so step number 3 was great. So now you know exactly how to enter the market. But this pretty much means nothing unless you know where to place your take profit and where to place your stop loss. And again, this is fully mechanical, and this is really, really simple. So let's take another long example right here, right? We've seen the Asia or London low print right here. So we're going to mark on the range high and the range low. We're looking for that manipulation below the session low. And let's say that we do get our confirmation right here. So we get a 15-minute bullish confirmation indicating that momentum is actually stepping into the market after the manipulation. So this is essentially the market showing its hand. So as we know, we can enter via a buy stop in the market just above this 15-minute candle high. You can account for some spread in the market. So if you're trading ES, US 500, what I like to do is place a buy stop 0.5 points above the candle high. So 0.5 points above this high right here. This is to account for spread in the market. And then what you're going to do is place a stop loss below the manipulation. So this is really important, not below the confirmation, not below the candle low, but below the manipulation. Sometimes you're going to find that this candle low is the low of the manipulation, and so that would be okay. But it has to go below the manipulation because this is when you're wrong in the market, right? If we then, roll lower and break this low after the confirmation, well, the market's telling you that we're now making lower lows in lower highs in the market, right? We have a low, we have a lower high, we've then just made a lower low. And so at that point, that's why I want my stop loss to be right here, because this is when I'm wrong. Sometimes I see people having a way too tight of a stop loss. They may put a stop loss sort of in this area right here in sort of like no man's land. Well, price could easily just pull back a little bit and then continue higher, and then you've just been stopped out and missed the continuation. And so I would much rather have a slightly wider stop loss rather than getting, stopped out all of the time and missing or being stopped out when the trade is not even invalidated. Okay, cool. So the stop loss always goes at the low of manipulation. So, of course, if you are longing the market, right, you're going to have a stop below the manipulation. If you're shorting the market, you're going to have a stop above the high of the manipulation. Okay, targets. Well, I like to keep things very, very mechanical. So once you're tagged long, you're going to be looking at targeting a mechanical 1 to 2. So we're not looking at taking a home run out of the market. We're just looking at taking a small, repeatable, bite-sized piece out of the market over and over again. What I found when I tested this system, right? I tested a 1-to-1 risk to reward, a 1 to 2, a 1 to 3. I tested all of the risk to rewards up to a 1 to 10. And what I found is a 1 to 2 was the optimal risk to reward. So it gave us the most amount of returns with the least amount of drawdown. So, I'm not guessing by saying, use a 1 to 2, right? I've looked at this system over hundreds and hundreds and hundreds of trades to ultimately come to this conclusion. And this is also a huge problem that so many traders are facing, right? They're going to get tagged long right here, and, price is going to start moving very, very quickly. Let's say it hits a 1 to 2 in like 30 minutes time. Well, they're then going to get emotional and they're going to go for the home run, right? They're going to think that price is just going to keep skyrocketing to the upside. And what often ends up happening is, it might hit a 1 to 2. If you're lucky, it's going to hit a 1 to 3, and then price reverses. And then you're sat there, you've gone from, being plus $1,000, $2,000, and you've just took like a -1 R loss. All because you're being greedy in the market. So it's really important that we stick to a mechanical, fixed risk to reward. This helps take all of the guesswork out of your trading, and it allows you to stay objective, right? Sometimes people look at maybe targeting liquidity. Again, this can be very subjective, right? Do you take like the previous day's high? Do you take like a previous session's high? Like these are all very subjective ways, right? So for me, I'm like, okay, well, I'm just going to stick to a mechanical way. It works. It's proven. Yes, there's going to be some trades where price goes like a 1 to 5 and you're sat there, but at least that's not your trade. That is not your trade. Our trade is just taking that small piece, that 1 to 2 out of the market, bank the profits. We're then going to come back the following session or the following day, and we're going to rinse and repeat the process. So very quickly, let's look at a sell example. So where is your sort of stop loss and take profit going to be, right? So we're sell buyers. We've seen a manipulation higher. We see our confirmation right here. Well, the stop loss is always going to go above the manipulation. So above the manipulation, our entry is going to be on the break of the 15-minute candle low, and we're going to be targeting a mechanical 1 to 2. So let's say right here is a 1 to 2 risk to reward. We're going to be taking this small sort of bite-sized piece out of the market. We're going to take the profits. We're going to then regroup and come back the following day. So this all means pretty much nothing unless we see some live trade examples. So what I've done is I've put together 6 trade examples. These are all trades that I've literally just took this month and last month with all of my exclusive members and my one-on-one students. Let's break them down. So I'm going to start with trade number 1. Okay. So first of all, you can kind of see how I do things, right? You can see we have the exact entry. You can see US 500 is being triggered long. We have the entry, the stop loss, and the exact take profit. So let's just break it all down. Right? We have the 50, the 100, the 200 EMA. So this indicates to us that we have a long daily directional bias. We have the London session low right here. So we have the London low and the London high. So because we're long bias, we need to see a manipulation lower before we can think about taking a position to get long in this market. So you can see this is the manipulation right here, as price either wicks or closes below here. Then what we're waiting for is that 15-minute bullish confirmation right here. We can enter on the break of this high via a buy stop in the market. We have a clear invalidation below the manipulation, and we can look at targeting a mechanical 1 to 2. Okay, so we have daily bias, we have a session-based manipulation, we have a confirmation, and we have a clear entry schematic, clear target, and clear invalidation on the trade. So notice how everything is fully defined here. Everything is fully mechanical, and there's no guesswork in this system. There's no guesswork in executing this trade. And so if we move over to the right-hand side of the screen right here, you can see US 500 plus 2R to the absolute tick, and we were in and out of the market. So exact entry, stop loss, take profit at a 1 to 2. We're not looking for a home run, right? And notice how we get this quite a strong rejection off this level. Again, this is an indication to you as a trader that, okay, my take profit is in a pretty optimal place, because we pretty much hit take profit and then we've started to reverse. What ended up happening here was we actually got a little bit of a pullback and then price continued higher, okay? But again, that is not our play. Our play is just to take this small, bite-sized piece out of the market, bank your profits and then move on to the following session or the following day. Now let's look at another trade example right here. So you can see US 500, this is of course ES, right, which is tag long. We have the exact entry, stop loss, take profit. Okay, cool. Let's zoom in, right? This is the 15-minute time frame. 15-minute time frame. Again, we're bullish. US 500 has been bullish for some time, right? Bullish for some time. 50, 100, 200 EMA. We've seen a manipulation below the Asia low. We then wait patiently for the confirmation. So this is your 15-minute bullish confirmation right here. We can enter on the break of this high, invalidation below the manipulation, and then we can look at targeting a mechanical 1 to 2. So this is a valid A+ setup. I would take this trade every single day in the markets. And one theme that you're going to see with these systems and these trades is they all pretty much look the same. And that's how trading should be, right? If you're trading a mechanical system, pretty much all of your trades are, they're not going to be identical, but they're going to be very similar. And then if we have a look at the outcome of this position, right, you can see we pushed into profit, right? Entry here, pushed into profit. We had a pullback back to entry, and then price sort of consolidated for pretty much 3 hours. 3 hours of consolidation. We're already positioned. And then we had the NYSE open, so the New York Stock Exchange open. Volume came into the market, and the 1 to 2 risk to reward was hit. So here is a great example of how important it is to not micromanage your positions. Right? If you went to break even at a 1 to 1, well, you would have been stopped out at break even, only for then to watch price hit your take profit. So it's really important that we adopt a sort of set and forget style. Once you're tagged into a position, it is what it is, right? Either your take profit is going to be hit, or you've defined your risk and you know what you're going to lose if the trade does hit your stop loss. The only time that I would micromanage a position would be the likes of let's say, it's going to be NFP, CPI, or some of the Powell speeches. Okay, so if you're trading directly into one of these events, right, I would maybe look at closing this prior to the event, or I would look at closing prior to this event, okay, because these events are extremely volatile. They can create a lot of whipsaw, they can create a lot of volatility, and also can create a lot of slippage in the market. So in general, I adopt a set and forget style, but there is the odd time where I'm going to be closing prior to NFP or CPI, which is, once a month. If I'm not positioned prior, well, I'm just going to wait for the news to come out. And then often this is what creates the manipulation before we get a continuation higher. So often what you find is the news, right? The news, let's say this is like the Asia low here. The news is what creates the manipulation lower before we get the continuation higher. So this is something when you see it in the live markets, right? It's something that you cannot unsee. Okay, so let's look at a further example, right? So the trade that we've just recapped was actually an internal position, which was inside of a macro position. Okay, so what I mean by that is if we read this sort of dialogue here for myself, right? What an amazing day, ending the day plus 4R. We had a position from Thursday, which also hit take profit, right? Also hit take profit for a 1 to 2. Congrats to everyone that held this position. Again, patience really paid off. Okay, so if I just zoom in right here, this is another position from the Thursday, right, where we were long bias, 50, 100, 200. What did we see? Well, we saw manipulation below London, also below Asia, right? This is what I call an extreme manipulation, where we take out not only one session, not only London low, but also Asia low. We then get our confirmation right here, 15-minute confirm, enter on the break of the high, invalidation below manipulation, target of 1 to 2. I cannot stress enough how patient you have to be in the markets. Yes, this trade had a slightly wider stop loss. So you're going into this position understanding that, yes, it could play out today, right? We could see price just continue higher, it plays out, and it hits take profit today. But that's probably not the most likely scenario. And so when you're entering a position with a slightly wider stop loss, you're understanding that, okay, I'm going to have to be very patient here. A lot of traders struggle with patience, with discipline, with maybe micromanaging, getting emotional, closing this early, going break even at a 1-to-1. There's so many ways you can see how so many traders would have went wrong here. You go break even at a 1-to-1, you stop to break even. Right? If you get emotional down here when we have an excursion of 50% towards your stop loss, well, okay, you micromanaged, you missed out, right? And so this was an example of scaling into a position. So if I zoom in here, you can see, this is the trade we just recapped before where we had the Asia low. We see that manipulation, confirmation, etc. So this allows us to scale into an existing position. Then what I'm going to do, because this entry price is higher than the previous, I'm going to move this entry, I'm going to enter here, and I'm going to move this first position, I'm going to move this to break even. So then this trade becomes risk-free at this point. So at this point, the first position goes risk-free, and then we are, playing with the house's money at that point. And so that's how this day ended up being a plus 4R day because, not only did we have this position which hit take profit in New York, we also had the prior position which we held because we had to be very patient, and this also hit take profit at the end of the day as well. So I'll be honest with you, this is not every day when you're going to have days like this. But it's important that when the days come around that you're prepared and you have a plan and you know what you're looking for so that you can take advantage of it. Okay, I now want to be very, very transparent. So let me show you a losing position. So you can see right here, if we zoom in, here's another example, 15-minute time frame, 50, 100, 200 EMA, sell bias. Okay, cool. So we're sell bias right here. We have seen a session manipulation above the London high. We then get a 15-minute bearish confirmation. We can enter on the break of this low. We have an invalidation. We have a target. Everything's fine. This is an A+ valid trade. We were then tagged in on the next candle. It pushed lower. Our sell stop was tagged in, and we essentially set and forget this trade. So you can see right here that US 500 was tagged short, the exact entry, stop loss, etc. Right? This is the entry right here. And you can see the live commentary, right? We ended US 500 with a -1R. And I noted as well that is me done for the day and for everybody to have a great weekend as well. So, we took a valid A+ trade. It was a losing position. I'm not then going to get emotional and start revenge trading. I'm then not going to, change my plan and look for something that isn't my trading plan. So it's important that you're disciplined and you call it a day. You're done for the day, you're done for the week, and that you come back the following day or session to repeat the process again. Okay, cool. Let's look at another trade example. So this is in the New York kill zone, right? So eyes on US 500 for potential long entries. You can see US 500 is tagged long, the exact entry, stop, and take profit. Let's zoom in, right? This is going to notice how this is starting to get repetitive, right? We're bullish in the market, 50, 100, 200. We see a manipulation below the London low, And this was actually off the back of CPI. So this large liquidation right here, this was due to a red folder USD news event. This is what you often find, right? The news is what creates the manipulation. We then got the confirmation right here, enter on the break of this high, invalidation, right? Target of 1 to 2. Again, this is quite a large stop loss, but at the end of the day, we have to stay mechanical. We have to stay objective. We're not looking at, getting involved really. And so if we look at the outcome of this position, right, US 500 plus 2R, and we zoom in, this was the exact entry right here. We didn't really get any sort of excursion towards the stop loss, maybe 0.2% excursion towards the stop. But over the following day, this trade did hit take profit for a 1 to 2. Again, how patient do you have to be? If you had to close this at the end of the day, maybe you closed it here at a 1 to 1.8 risk to reward. Maybe you closed it here at the end of the day. But ultimately, the people that were very patient and disciplined and followed the rules, you were rewarded for that discipline, for that patience, right? And you can see we did hit a 1 to 2. But price pretty much went sideways. We had, a pretty boring day in the market. And then we started to get some volume coming in towards the end of the day. But again, pretty choppy. Okay. So once we were tagged in, I set and forget this trade. We're not interfering. We're not micromanaging. We're not getting emotional. Allow it to play out. Okay, cool. We're getting there. Here's another example. Bullish in the market. Again, a great example of how the EMAs are very close together. They're actually sort of sloping to the downsides ever so slightly, but they are in order. So what does that mean to us? Well, we are long bias. Okay. So we see manipulation below London right here. If we zoom in, it's very minor, but we did wick below here. And so we got the confirmation right here during the New York kill zone, right? Remember, price has to confirm between 8:15 a.m. And up until 10:29 a.m. Eastern. So this is your first candle. Enter on the break. Invalidation, not below the candle, but below the manipulation, right? Validate plus setup. Head over here. Here's the outcome, right? Gold plus 2R. If we zoom in, you can see we got that push into profit. We got very close to take profit, back to entry, and then patience paid again. If you micromanage, you went break even, you got emotional at this stage or what have you, you're not seeing this profit. You're not in the market at this stage, right? So again, an example of how the set and forget style is really beneficial. Okay, cool. Let's keep moving, guys. US 500 plus 2R. Secured my full position, right? So if we look at the exact entry, US 500 triggered short, right? Entry, stop, take profit. What do we have? This is a London session, right? London session setup. So we are sell bias, Asia high. We have a slight manipulation above Asia, session-based manipulation. We get a confirmation. This is at 3:15 a.m. Eastern, right? Entry on the break of the low, stop above the high, target of 1 to 2. Right? And then, of course, as we've seen, this is the outcome of this trade. We pretty much wick the absolute low and we're starting to reject. So again, an example of how important it is to, take your profits. We're not looking for a home run. And also a sign that our take profit is in a very optimal place. We got tagged short here. We had a pretty decent excursion around 50% towards the stop loss. And then price started dropping significantly lower. And ultimately, we took out the liquidity below the Asia session low. Some of you guys might not be able to trade the London session. That is okay, right? Don't try and force trading around your lifestyle. Your lifestyle should revolve around trading. So if that means that you can only trade and navigate the New York session, okay, cool. Well, that's the session that you trade. Don't then try force it into the life because then, your sleep is going to be affected and it's going to be a lot tougher for you. But I would say in general, the majority of the trades, they set up in New York. You can see that, right? A lot of the setups that we covered are setting up in the New York kill zone. So notice how every trade, every execution, and every confirmation, this came either in London, 3:15 a.m. up until 04:59 a.m. So every trade was tagged in during this time, or it was tagged in between this kill zone, the New York kill zone, between 8:15 a.m. Eastern and up until 10:29 a.m. Eastern. And of course, this is the New York kill zone. So notice how all of the trades are executed during these time windows. We're not taking any trades outside of these windows, and we're not taking any trades in the Asia session. We're just using the Asia session, the range of the Asia session, in order to identify areas of session-based liquidity. If you would like to learn more and you would like to see me trade this live every single day in the markets, and you would like to see my exact game plans, trade plans, and market executions, and you would like your hand held every step of the way, where you're going to learn the exact blueprint to this fully mechanical, rules-based trading system, then make sure to check out my exclusive community or my one-on-one mentorship. The link is in the description down below. As always, thank you so much for your time and support, and you take care. Bye-bye.